on what this report might mean for the Fed and what it might not mean.
Headline inflation, I should say, slowing down for the third month in a row in December, though still remaining high overall. If you look at the consumer price index, that fell, as you just noted, by 0.1% last month.
If you look at the components that fell the most, it was energy prices, which the Fed doesn't have anything to do with, really. So what's your read on this report?
I think we can say that inflation has peaked, but the level of inflation is nowhere near where the Fed wants to be. So they're going to continue to tighten a little bit.
Fed near done, inflation cooling, economy holding up, maybe it means soft landing.
Recent inflation data, while positive, shows that price increases are indeed cooling, but have further to cool. Now, expectations are going around that the Fed will change its course of action and pivot anytime soon towards softer monetary policy. So, what do you think we're going to see in 2023? Can the Fed pivot, or are we going to see more aggressive rates this year? To answer all these questions, today in this video, Mark Yusko has highlighted the situation around inflation, Fed interest rates, and the market situation in 2023. So stay tuned until the end. And to stay updated with the latest news and updates on the economy and markets, don't forget to subscribe to my channel. You can also hit the bell icon to never miss any of my latest videos. But without further ado, let's get into it.
That I believe inflation is fading, right? That I believe that. That's my first five, syllables. Economies are slowing, right? It is incontrovertible that economic growth is slowing around the world. Now, I will argue it's not collapsing like depression, but it's slowing. And I think that's the point of the lag effect, as you say, as rates rise, there's a bite. And how have people survived at this point? How did everybody travel this Christmas and jack up prices of hotels in Park City, Utah? Well, they borrowed on credit cards, right? Savings has collapsed from that massive spike, quote unquote. It wasn't really savings, but we handed people money. They called it savings, but that's all gone. I mean, it's literally all gone. And so credit card debt is skyrocketing, and that, but it is, I believe, like the 2001 recession, which was very shallow, and it had the chance to get really severe post 9/11, but it didn't, because people kind of came back. And I think the same thing's going to happen here. We'll have this shallow recession. Maybe they don't even actually ever call it a recession, although it's hard to argue. If you look at leading economic indicators, you look at prices paid, you look at ISM, PMI, there's nothing other than employment, which I will argue the employment number is just bogus, right? It's the birth-death ratio problem. The fact that they haven't called a recession means they can keep this nonsense of saying that so many companies have been born and die. I just think that's just bogus. And taking people out of the labor market when they turn 65 is just wrong. It's just not true. But facts aside, the Fed isn't going to pivot to cutting anytime soon.
US CPI data for the month of December has been released. The year-on-year inflation number for December has fallen to 6.5% from 7.1% seen in November of 2022. Rising consumer prices in the United States moderated again last month, bolstering hopes that inflation's grip on the economy will continue to ease this year and possibly require less drastic action by the Federal Reserve to control it. But, according to Mark Yusko, inflation is surely fading, but that doesn't mean the Fed pivot is going to be seen anytime soon. Mark Yusko also has highlighted that even as it gradually slows, inflation remains a painful reality for many Americans, especially with such necessities as food, energy, and rents having soared over the last 18 months. For now, more Americans are leaning on their credit cards in the face of rising prices. I mean, these days, one look at the price tag on eggs is all it takes to understand why people have piled up credit card debt. Now, credit card interest rates are also skyrocketing, just like everything else in the world. The average interest rate on credit card debt has soared to nearly 20%, from just over 16% at the beginning of the year. Part of that enormous jump is because the Federal Reserve keeps raising interest rates, and every time the Fed does that, your credit card debt becomes heavier. So, how long can inflation go ahead, and how much will the Fed raise rates in 2023? Let me know your thoughts in the comment section below. Let's get into the next clip to hear what Mark Yusko has to say next.
I think inflation is going to crash, like super crash. I think we'll be I'm going to say sub 3 by the end of the year.
Okay.
We'll be back in that 2 zone. We won't get back to 2, but we'll be sub 3 by the end of the year. Now, how high can they turn the crank before everything breaks, right? I just always look at it that, look, the Fed, it's a building full of PhDs, right? Like some of the smartest people on the planet, in theory, according to their credentials, work there. And yet they're over. Like I keep this stat. I mean, they're over 238 or 39, whatever, predictions of GDP for the next quarter. Not like for 10 years out, but just for the next quarter. They're over. They've never got it right. So I always wonder, are they too cute by half or too smart by half? And they're too smart for their own good. And therefore they think they're so smart and the markets aren't smart. And therefore they just don't react to the right stimulus. I don't know. It's weird because they clearly didn't acknowledge what happened. You lock down the world and everything goes to zero. And then you unleash everybody and it all goes up a lot. And you measure that and you say, oh, that's inflation. I'm like, well, I don't know. I don't think oil prices are going to triple again. I think they're going to go higher, but I don't think they're going to go from 40 to 120 again. And the fact that they are now down over the last 12 months means that component of CPI is negative, not positive. So hard to overcome that. And so this idea that they're waiting to react for something, whatever that thing is, whether it's this, mythical employment dip.
The softer readings add to growing signs that the worst inflation in 4 decades is gradually waning. Still, the Fed doesn't expect inflation to slow enough to get close to its 2% target until well into 2024. The Consumer Price Index data for December shows inflation rose 6.5% from 12 months earlier, in line with expectations and down from a pace of 7.1% in November. This marks the 6th consecutive month of declines in the inflation rate, and with it, the 6th consecutive month of renewed hopes for a Fed pivot to lowering interest rates. But the data suggests that little will change in the Fed's approach. While the overall inflation rate fell, much of the decline was concentrated within the energy sector. Energy services declined 17% month over month, while gasoline prices fell 9.4% over the same time period. The recent CPI data implies that conditions are moving in the direction where the central bank can consider further moderation in the pace of rate hikes. Let's hear more from Mark Yusko in the next clip, but before jumping ahead, be sure to give this video a big thumbs up.
The Fed isn't going to pivot to cutting anytime soon.
Yeah.
Which then how does money supply grow? Well, that actually is the one fly in my ointment, in the sense of, in a world where money supply actually shrunk, global M2 actually shrunk for the first time in decades. It makes perfect sense that equity markets struggled, that private market struggled, that real estate market struggled. But I look out at government debt, right? I mean, Japan last night had to intervene again after they said they weren't going to. They had to go buy bonds because their bond market was seizing. 3 months ago, it was the Bank of England. And the Fed is the only buyer for U.S. government bonds. There's no one else around the world. And this alliance of the aggrieved is going to exacerbate that problem, right? If they are going to price oil from Saudi to China, from Saudi to or Russia to China, if they're going to price that in renminbi instead of dollars, demand for treasuries as collateral goes down, just does. And that's my other one about the dollar, right? King dollar dethroned. And look, we've had Brent and the dollar milkshake, and look, we had the dollar squeeze that he predicted, and right on. Brent was exactly right, but it peaked, and since October 24th, dollars down like 12, 13%. And I think it's going down a lot.
To conclude, Mark Yusko believes it's going to take time for the Fed to pivot. Consumer inflation isn't the only issue bothering the Fed. There's still wage inflation and the potential for slowing growth. Only time will tell how the Fed will react in the coming months. Still, many experts believe that there's going to be a constant parade of hawkish Fed comments. So, what do you guys think? Can we see the Fed pivot ahead? Have we seen peak inflation? And how will the market react ahead? Let me know your thoughts in the comment section below. For more videos just like this one, be sure to subscribe to my channel. You can also hit the bell icon to never miss any video that I upload. And don't forget to like and share. I'll see you guys in the next video. Adios, and thanks for watching.